Good afternoon, everybody. Welcome to Tax with Sachs. This is a series which we started about a year and a half ago, and we are back today with a look back at Q1. Next slide, please. Before we get started, some of the housekeeping items. Our firm provides the information in this webinar presentation for general guidance only, and this does not constitute the provision of legal advice, tax advice, accounting services, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with a tax professional, accounting, legal, or any other competent advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all pertinent facts relevant to your particular situation. For those of you looking for CPE, the following is the list of items which you need to take care of. You must stay connected to go to webinar for the entire duration of this presentation. Partial credit is not available. Participants must answer 75% of the polling questions. Today we have a presentation of an hour and a half. So out of the 6 questions, you have to answer 4 of them. If you have difficulty answering the polling question, that is, if your answer does not register, hit the escape key to minimize your screen and try again. If that does not work, please type into the chat box and we'll take care of it. The participant course evaluation in the handout section of the control panel should be downloaded, completed, and emailed to jtoshi@saxllp.com to receive the CPE credit. The certificates will be emailed to you within a few days of the webcast, and we generally record these webcasts along with the slides. They will also be emailed to you within 24 hours. With that, it takes me great pleasure to introduce you to our presenters today. Lisa Coleman, who is a partner at the international tax side. Lisa specializes in international taxation. She creates strategic and domestic international tax minimization opportunities for our clients who are high net worth global business leaders and multi-generational families. Lisa regularly structures the holdings and transactions in their non-US corporations, trusts, states, and other entities. These frequently include private companies, alternative assets classes, and real estate, including cryptocurrency. Lisa began her career in the Big Four and worked at other mid-sized firms as well. We also have Richard Goldstein with us today, who leads up our SOLVE practice. And Richard has experience of 30 years dedicated exclusively to SOLVE and local tax matters. Richard advises clients on a wide variety of state and local tax issues, including personal and business matters, tax planning, tax compliance. He also represents clients in states and local tax audits, tax appeals, and voluntary disclosures. Richard, prior to joining Sachs, also worked at the Big Four. So over to you, Lisa, to take over the presentation.
Thanks, Shivani. It's a real pleasure to be here, especially with Rich. Our practices often overlap, whether our clients are crossing our federal or national border or state borders. We find that we work quite a bit together. So we're hoping today's webinar to be more of a discussion about our practices and how we're able to work together. We're going to divide the discussion into 2 parts. The first is going to be focus on individual taxation and residency for non-US individuals immigrating into our country. And then also Rich is going to spend time talking about state tax residency, including domicile issues. And then secondly, we're going to talk more about business matters on outbound and inbound investments and what's the right way to structure or to consider the investments and the taxation from both the federal level and from the state and local tax levels. So we will begin with the individuals. So next slide. So the first question we ask is, how is US tax residency determined? And I'm not going to spend a lot of time on this because at the end of the day, it's really a math problem. But it's important because if you're an individual and you're deemed a US income tax resident, you're taxed on your worldwide income. So there are 2 basic tests for determining residency. The first is the green card test, and basically if you have a green card, that means that you're a permanent resident of the US, or regardless of whether you're here or not, the green card is permanent residency. So the default is that you're a US tax resident. And then secondly is a substantial presence test. These tests are important to consider when you're thinking about immigrating to our country, so we can do planning prior to immigration. And also they're important to consider, as I'm going to talk in a few minutes about our tax treaty system and ways to plan with the tax treaties. And I just want to talk about a client I have and why, you know, you could fall into these tests. I have a client who's from a non-treaty country in the Middle East, and she overstayed her 90-day visa, visitor visa by 18 months. She comes from a very wealthy family and has access to a lot of assets. And she wanted to immigrate legally, but she knew that she was here as a U.S. tax resident and hadn't been compliant. You know, the issue became is that she's got an access to a lot of wealth. Her father gifts to her, and she sold some land in her home country. And all these things are U.S. tax reporting issues. So it's important to understand these rules before you fall into a situation like she fell into. So let's go to the math, which would be the next slide. So the substantial presence test is triggered if you're considered substantially present in the U.S. It's two-pronged test. If you're in the country for 31 days, then you have to look at the second part of the test. The second part of the test is our math. You count the days that you're in the country in the current year, and you add that to a third of the days that you're in our country in the preceding year, and then a sixth of the days that you're in our country from the second preceding year. And I think that leads us to our first poll question, which is going to help with the math. I guess I'll go through it. So our poll question is about Bob, who's a Brazilian citizen who came to the U.S. on vacation on March 1st, 2022. He's still in the U.S. today, April 25th, 2023. So if we count the days, he was in the U.S. for 115 days in 23. He was in the U.S. for 306 days in 22, and he wasn't in the U.S. at all in 21. So the question is, should Bob leave tomorrow to avoid U.S. residency, or is it too late?
I'm going to give it about 10 more seconds before I close the poll. So if you're looking for CPE credits, this is your time to answer the questions.
So the answer is, it's 73% of us got it, that it is too late, that he's already a U.S. tax resident for 2023. And if we look at the answer, we can see how the math works, which means that he was in the U.S. under our math test for 217 days. And then a second question, let's say Bob in 2022 decided that maybe he wanted to leave because he was he a U.S. tax resident? And the question is, and he never was in the U.S. prior to 22. So was he a tax resident in 22? And again, the answer is yes, because he was here for 306 days, and we count 100% of the days in the current year. So poor Bob, he's got to file tax returns and report his foreign assets. So let's spend a minute talking about tax treaties and how to use them to your advantage. The U.S. has negotiated tax treaties with a number of foreign countries. There are three basic types of tax treaties. There's the income tax treaties, totalization agreements, which relate to Social Security, and estate tax treaties. The basic goals of a tax treaty is to avoid double taxation, and they're effective for both individuals and businesses. But I want to spend a minute talking about how it relates to individuals and dual residency. So dual tax residency is a situation where a U.S. taxpayer is considered a tax resident of both the U.S. and another country's another country. And this can happen when an individual spends a significant amount of time in another country, or has assets in that country or a business in that country. When a U.S. taxpayer is considered a tax resident in both the U.S. and another country, they may be subject to double taxation on their worldwide income, which is not a great situation. So to avoid the double taxation, the tax treaties will define how do you consider which country has the first right to tax, or which country would that individual be considered a tax resident. And you look to certain tests, and each treaty has little nuances to what tests apply. But what is great about the treaties is there's a lot of planning that can go on. I have several clients that we've used these provisions to our advantage in that they're considered residents in their home country. And we can often take that position that they're non-residents of the US and therefore they're only subject to tax in the US and their US source income. However, if a US person is considered a non-resident under the tax treaty because of those provisions, doesn't really mean that they're non-resident for state tax purposes. So that's my segue to Rich talking about state tax residency.
Thanks, Lisa. I want to thank everyone for being here and today. So yeah, as you know, my part is state tax resident classification. And, you know, we have 50 states. Not every state has a personal income tax, like Florida, Texas, Alaska, and there's a few others. But for those that do, we have to make a determination as to whether or not you're a resident of the state. And almost every state that has a resident statute uses something called statutory residence, which is the first bullet on this slide. And basically a person who spends more than 183 days, in other words, you know, more than half of the year, calendar year in a particular state and maintains a permanent place of abode. And again, permanent place of abode, the language might vary somewhat from one state to the next. For substantially all the year is a statutory resident. So it's really just math. It's, you know, how many days have you spent here in a particular state, and do you actually have a residence in that state? And if you do, then for that year, you're a resident, and it can change from one year to the next. The second way that certain states will classify you as a resident is if you're domiciled in that state. And the domicile, it means that it's not a mathematical formula. It means that looking at subjective factors, is your primary home that state? Everybody is born with a domicile, and domicile doesn't change usually from one year to the next. It's sticky, and so it's very different than statutory resident, being a statutory resident. You can't just turn on and off being a domiciliary of a state. Now, what are the things that states look at to make a determination as to whether or not you are domiciled? We'll look into that in a bit. But first, what I want to do is take a look at the first item, which is statutory residency. And I'm going to use New York as an example. So what is an abode? You have to have a permanent place of abode. So in most states, like New York, will say that the abode needs to be suitable for year-round use. So it can't be, you know, you can't have, let's say, a cabin or a bungalow, and that is not a permanent place of abode. That won't cause you, even if you spend more than 183 days in the state, that won't cause you to be a statutory resident. It's not suitable for year-round use because these things are not winterized, and you know, that's the primary reason, is that they're not winterized. That's almost pretty much the biggest issue. And so if you want to spend some time in New York, one of the things you can do here is own a cabin that isn't suitable for year-round use, and there you go. You don't have to worry about how much time you're spending here. Until recently, you know, if you say you lived in one of the border states of Connecticut or New Jersey, and let's say you worked in the city of New York City, right? But you lived in New Jersey or you lived in Connecticut, and because you know, things have certainly changed since COVID, but let's assume that you come into the office in New York City to work, and therefore you're here a lot, and then let's say you have a vacation home in New York State, upstate New York, let's say. The rule used to be that you better watch the number of days, because even if you were not to visit your home, in New York, your vacation home, one day, the mere fact that you have a home, a residence that's suitable for year-round use, whether you use it or not, um, if you hit 180, if you go over 183 days, you're a statutory resident. And that would sound ludicrous, because the average person would say, well, but I'm not using my home. The home is 300 miles upstate New York. I'm just coming to the office. Doesn't matter. Until a case called Matter of Orbis was decided very recently. It was only decided in June of 2022. And that now, we'll go into that in a little bit, but basically effectively gives you some wiggle room to be able to have a second home in New York and not become a resident just because you spend more than 183 days in New York. If that home is something akin to a vacation home. In New York and in many states, any part of a day that is spent in New York, even if you just cross the border, and you go grocery shopping or whatever you do, any part of the day in New York counts as a whole day. So if you spend an hour here, it's a whole day here. So you have to really be careful about not, if you're trying to avoid New York residency and you have a residence here and you don't want to be a statutory resident for tax purposes, you have to make sure that you're not even spending little pieces of the day in New York, because that will count against you. And there's two basic exceptions. And again, I'll say this one more time. I'm using New York as an example, but most states have these sorts of rules, very similar. If you're traveling or passing through New York, meaning let's say you're in a bus, on a train, in a car, using the airport, and you're not doing anything other than traveling through New York, that wouldn't count as a day in New York. A lot of folks plan residency status if they have an apartment in New York City, and they are frequently in New York. Let's say they fly to New York from California or wherever. They'll plan their day so as to maybe fly into another state like Newark Airport, New Jersey, and take the latest flight possible so that they don't end up in New York before midnight, and so they don't have to worry about inadvertently adding an extra day to toward the 183 days. Days that you were confined to a hospital or medical facility don't count toward the 183 days. And but it's very narrow exception. Going to see a doctor is not the same thing as being confined to a hospital. Visiting a person, whether it's your spouse or a friend or whoever in the hospital, that exemption doesn't apply to you because you're not confined. And then another part of, again, a lot of states will say, okay, we were talking about the 183 days, but what about the permanent place of abode? Do you have to have, if you have a residence in New York, but you only had it for 2 months, you moved in November, you moved in December, 1 month. I mean, does that automatically put you into the 183-day rule? And the answer is no, because you have to have a residence for substantially all the year. And beginning in tax year 2022, the New York State Audit Guidelines provide that a general rule is that the abode must be maintained for a period exceeding 10 months. So if you don't have an abode in New York for more than 10 months, even if, let's say, you spent more than 183 days because you kept coming for work or whatnot, then you don't have to worry about being a statutory resident. Just as a sort of interesting fact, prior to 2022, the period was 11 months that you needed to be in New York at least 11 months. So they actually changed that rule to 10 months. And I guess I'm ready for the next slide. Maintaining a permanent place of abode. Okay, so that was the second part of the equation. I said we were going to talk about what does it mean to maintain an abode. It's not necessarily ownership, right? Just owning a piece of real estate in New York, an apartment, that doesn't make it your abode, right? So you can own a piece of property as an investment. You can own a piece of property as a rental property. And even if you spent more than 183 days, you would not run afoul of the 183-day rule because you have to maintain it as an abode. And over many years, these are the key issues that come up. The question is, do you have unfettered access to the residence? Can you come and go as you please? Do you keep personal belongings there? Do you contribute to the upkeep of the abode? So even if, let's say, your friend owns that house and is letting you live there, or partner or girlfriend, boyfriend, whatever, if you're contributing to the upkeep of the house, it's your abode. If you have unfettered access, it's your abode, even though you don't own it. You may not even be paying rent. You have to have a residential interest in the home, meaning it's being used as a home, as a residence. And you can have many residences. You can have many permanent places of abode. And so for those where you're spending more than 183 days in the state, you could be a resident and not in another one. And you can only have one domicile though. So let's go to the next slide, please. Okay. Actually, we're not at domicile yet. I'm going to go into Orbis a little bit. Orbis is really good. It changed the playing field for so many people who own vacation homes in New York. There was a strong deterrence from owning a vacation home in New York. Because if you had reason to spend more than 183 days in New York, and let's say your real home was New Jersey or Connecticut, even if you only used the vacation home, 2 weeks out of the year, 3 weeks out of the year, suddenly you're a resident. So, a lot of folks did not want to own real estate here, vacation homes. But in this case, it was a recent decision, June 30th, 2022. The person in this case, Mr. Orbis, he was domiciled in New Jersey, but he worked in New York City. His vacation home was upstate. It was furnished. It was suitable for year-round use, but it was 4 hours from his office in New York City. Now, Orbis spent more than 183 days in New York in 2012 and 2013. Those were the years at issue. And he had free and continuous unfettered access. But it was held that the vacation home was not a permanent place of abode, because he didn't have a residential interest. He wasn't really living there as a residence. And some of the things that they considered was that the taxpayer used the dwelling no more than 3 weeks per year. He didn't keep personal effects at the house. He came and went with items. He really used the house to go skiing, and it was Saratoga Springs. He went to the horse races in Saratoga. And the house, quite frankly, just wasn't commuting distance from his office in New York. All those things add up to the person not actually having a permanent place of abode at that address. And so he wasn't a resident. If we can go to the next slide. Domicile is different, as I said. It's kind of sticky. Everyone's born with a domicile. You think of it as your primary home. And the evaluation is very subjective. New York, as well as many states in the Northeast and also around the country, will primarily make the decisions of whether or not they think you're domiciled in the state. If you have multiple homes, they'll take a look and see which homes are the most expensive, which home is most suitable for your lifestyle. Do you have a lot of children? Is it a big house? Does it have many bedrooms? How is the home being used? Is it being used, or do you, as a weekend home, or is it really being used as a primary home? And so, let's say you had a home in Florida and New York, they would make a determination and say, okay, well, your home in New York seems to be the primary one, but that's not the end of the story. They're also going to look at the relative amount of time that you spend in Florida and New York. Where are you spending more time? They'll look at, if you're in business or you're working, they'll look at where your center of your business life or working life is. Is it in Florida? Is it in New York? They'll look at where you keep your near and dear possessions, which can be things, things of great value, like art and wine collections, or it could just be things of sentimental value, I guess in the old days you had a wedding album. I don't know if you still have a wedding album anymore. I guess you just take that with you wherever on your camera. But let's say you have little art projects that your kids did for you, and you're still holding on to them, and they don't have any financial value, but they have sentimental value. So they'll look and see, where do you have more of those things? And then if you have minor children and you're married, they'll look at where your minor children and your spouse are. Now there's numerous other things that states will look at. They'll look at where you're registered to vote. They'll look at where your doctors are. They'll look at, where you belong to church, where you have a boat, where do you engage in your hobbies, and things of that nature. And the list goes on and on and on. Where you have a driver's license. Those things are very commonly used to determine where your domicile is, including the things I just mentioned. It just so happens that New York places those things as less important. And by far in New York, and not in other states necessarily, the most important ones are the 5 factors. So if 3 out of those 5 factors favor Florida, then you're a Florida domicile. If 3 out of those factors favor New York, you're a Florida, you're a New York domiciliary. And so that, that's the way the determination is made.
Rich, I just want to interject. We've had many clients that have left the U.S. and it's easier to leave the U.S. and break U.S. tax residency than to break domicile, right?
I think that's true. I think, as I said, the domicile is very, very sticky. You'd have to prove, if you're leaving the U.S., or quite frankly, if you're going to another state, not only these factors that we just discussed favor overseas, let's say, as your new domicile, but you'd have to demonstrate that you have actively created a new domicile and you have actually surrendered your old domicile. So that would mean that if, let's say, you took a home or an apartment in let's say in the UK, but you still maintained your home in the States, if you're not turning that home into a rental property, if you don't sell that home, if you don't cancel your lease early, you haven't necessarily broken your domicile. And even though you're living outside the country or outside the state in another state, you may very well be found to still owe taxes as a resident in the state that you claim you left or abandoned. So it's definitely sticky. And another thing I'll say is that, whereas you mentioned toward the end of your first part of your discussion about treaties, right? Well, New York is interesting in that, if you're not necessarily beholden. I said New York, but I should say states, because it's a statewide thing across the country. You're not beholden to those federal treaties unless those treaties explicitly deal with state and local government, and many of them do not. Many of them don't. So so in some ways, it's easier to get stuck in a state
I think we've had those discussions a lot of times with clients the two of us trying to explain that.
Yeah. How could I be, a resident of a state when
Right,
I'm a resident of the United States, right? That
Right.
seems wrong somehow, right?
right, somehow.
But wrong in this case is it can be right.
Right.
Are we on our next slide? I think we are.
Poll question.
Our polling question, okay. Okay, what is not a consideration for determining state tax resident status? A, the number of days spent in state. B, the location of your immediate family. C, having a residence in state. And D, the location where you had your favorite buy one, get one free low carb vegan spumoni ice cream sundae with crushed peanuts. So I hope this one isn't too difficult.
It's making me hungry, Rich.
It's buy one, get one free, so make sure to share.
Well, you and I,
Am I ready to reveal the answer? Can I do that now? Or do we need to wait?
I'm just waiting for some more votes to come in. I'll do it in about 5 seconds.
Oh, okay. And the answer is D, and 83% of the folks here got that right, which is pretty good, pretty good. All right.
all right. So I think we're going to move on back to the federal tax issues. We'll wait till we get to that slide. Great. So now we've determined we're U.S. tax residents. So why is it so important? And if you're considered a U.S. tax resident, then you're subject to U.S. income tax in the same manner as a U.S. citizen. So you're required to report and pay income tax on all your worldwide income, regardless of source, including wages, capital gains, dividends, interest. It also includes your share of earnings from non-U.S. companies that you own stock in, regardless of whether those earnings are distributed. If you are contributed to retirements or savings accounts that are tax-free in your country before you came to the U.S., those are not necessarily tax-free in the U.S., so the earnings inside those plans may be currently taxable. And while if you pay tax in your home country, you may think you're going to get a foreign tax credit in the U.S. and avoid the double taxation. The way the U.S. foreign tax credit rules are, they're quite complex. Sometimes you only get partial credit, so it's not always the best answer. And additionally, and sometimes this is the hardest discussion I have with my clients on the next slide, is really the reporting requirements. So can we flip to, there you go. So the reporting requirements are for a U.S. tax resident that have non-U.S. assets are quite complex and they're quite invasive, I guess is the word for it. You're required to report the details of all your non-U.S. bank and financial accounts, including the location of the account, the highest balance in the account. You're required to report all the financial information on shares that you hold in U.S. non-U.S. companies, including the company's financial information and ownership structure. And this information reporting is required regardless of whether there's any U.S. tax due. And the penalties for failure to report are quite complex. So it's sometimes not a great situation. And I'm going to move it back over to Rich. You could talk about state taxation.
Yeah, before you do, I wanted to ask you a question about the reporting. Because I remember being involved with, not primarily with folks who ran afoul of the reporting rules. And in order to resolve that, they had to do something that was annoying, right? Called a...
It's right, there's voluntary disclosure. There's many ways to disclose to become compliant. And it really depends on the situation. Did they know? Should they have known? and the penalty exposure for failure to report. So it's happened quite a bit. It happens all the time. People are either accidental Americans, meaning that maybe they were born here and left, or they were here, like my client who was here, supposed to be here for 90 days, stayed for 18 months. So, we had to figure out what's the best course of action for her to become compliant. And then in her situation, she was in New York City, she has an apartment here. So the conversation after the federal tax compliance always goes over to Rich and say, okay, how do we become compliant with New York? Because she also has reporting requirements in New York.
All right, I guess we're ready for the next slide.
It's all good news, Rich.
Okay. So if you're deemed a resident of a U.S. state, you may also owe income taxes in that state. And many states base their income off U.S. federal income, meaning an individual could end up paying state tax on their worldwide income. Next slide, please. Residents are typically taxed on worldwide income, as we mentioned. It can include things like earned income, from wages and dependent contractor income. It could include unearned income, like interest, dividends, capital gains. So you can see that that's what residents are taxed on. So it's pretty much everything, very broad. State adjusted gross income of a resident is typically based on federal adjusted gross income. And each state has, specific modifications. So they may start with federal adjusted gross income and then subtract some items, add some items. But the key to remember is, why does everyone want to be a non-resident and not a resident? Well, non-residents are only taxed on the state's source income, which generally would not include, things like interest, dividends, capital gains. Next slide, please. So state source income includes, this again, we're talking about non-residents. State source income includes income from a trade or business conducted in a state, wages and independent contractor income, and flow-through income, meaning income, through, a trade or business conducted through a partnership, limited liability company, and S corporation. Actually, I take that back. Partnership, limited liability company. Income from assets employed in a trade or business conducted in states can include even things like royalties from patents that are employed in a state, or copyrights, or income from equipment, like machinery rentals that are used inside the state, would be considered state source income. Income from real property located in the state, so rents from commercial or residential real property, and could even include income that is related to a business, trade, or profession that previously was carried on in the state, even if it isn't any longer. Next slide. Polling question number 3, okay. What is not a true statement? State residents are typically taxed on worldwide income. B, state non-residents are typically taxed on state source income. C, royalties earned from the licensing the rights to a Broadway show are New York source income. Or D, Spumoni ice cream is a tasty treat made from vanilla, pistachio, and cherry almond ice cream.
Seems like a trick question, Rich.
Yeah. It won't be difficult for all those Spumoni lovers out there.
going to close the poll now.
Okay, and the answer is a D, because Spumoni ice cream does not include vanilla ice cream. It's chocolate, pistachio, and cherry almond, and 64% got that right. Wow.
See, a lot of ice cream lovers. It's funny. So we're now going to turn over to businesses, inbound and outbound business investment in the U.S. and into the various states. And we'll start with the inbound discussion. Many non-U.S. investors want to enter into the U.S. market. So the question is why. So let's briefly cover things that we take from granted from the perspective of a foreign investor. The United States is a prime destination for foreign investors because we have a stable political environment, stable economic climate, a well-developed legal system that protects intellectual property rights and ensures fair competition. We have a diverse consumer base, many ethnic groups, many different cultural backgrounds, 325 million people live in our country, so it's a pretty big market. There's a lot of opportunities for businesses to target specific niches. We have advanced infrastructure, including transportation systems, telecommunications, our energy grid, which makes it easier to deliver products or to manufacture products. And we have a highly skilled workforce. We have a strong education system, and it's easy to find the right workforce for various businesses. So overall, the U.S. offers a pretty lucrative and compelling opportunity for foreign investment in the U.S. So next slide. So where do we start with these investors? The first step in the process is to choose the right type of business structure. And each structure has significant tax implications. There are three main types of business structures: corporate, partnership, and disregarded entities, or sole proprietorships. And there's each structure, each type of entity has its own set of advantages and disadvantages, and it depends on the goals of the investor and the nature of the business as to what's the right structure. For example, a corporation offers limited liability protection for investors, but it's subject to double taxation, meaning that both the business and its shareholders are taxed separately on their income. A partnership, on the other hand, offers a pass-through taxation, meaning the business itself doesn't pay tax. It's only tax that's paid at the partner level on their share of the profits. So in order to decide what the right structure is, we really need to understand what fits our client's goals. And I have another client example that Rich and I have continue to work on together. It's about a bed linen company that started in Australia during the pandemic, and it took off. It was a great business to start at that time. But the Australian market, and I don't know how big the population is, but it's much smaller than ours, and it's a limited market. So they wanted to move into the US. And their goal is to eventually exit the company. So structure is very important in terms of, how to enter the US market. And when we were meeting initially, we discussed ideas of just importing into the US without creating a presence here. And it would definitely simplify their life today. They wouldn't have, necessarily the state tax, corporate implications, income tax implications. They wouldn't have maybe federal tax filings. And it may make life easier for them in terms of exposure. However, that's not what their end goal is. Their end goal is to exit the business, and they felt that having a US corporate structure would be more attractive to a potential buyer. So while life may be simple now, it wasn't going to fit their long-term needs. So they started a corporation, and they're doing an amazing business. And Rich is going to go through later, because once I was done with the structuring, it became really a state sales and corporate income tax issue. And I think, Rich, they're filing in more than 20 states now. They're growing.
Yeah, I think that's right.
Yeah, so it's a pretty exciting time to be part of the client's future. So let's take a look at some of the questions that we need to consider when we talk about planning for inbound investment. First, like I just mentioned, we talk about the long-term plans for the investment. Are the owners planning to immigrate because the structure may be different, or are they trying to sell the business at some point? Secondly, what is the taxation of your other investors or of your client? Depending on your tax residency and the nature of the investment, you can be subject to different types of taxes, including withholding taxes, which can affect your investment returns. We always want to look at the effective worldwide tax rate when we're talking about multiple jurisdictions. Third, will there be any U.S. partners involved in your investment? It may be more favorable for a U.S. tax resident to have the pass-through structure, while for a non-U.S. tax person, the corporate structure may look more attractive. And I have another client that is also from Australia, wanted to start doing business here in the U.S., and they came to me after they structured. So what their structure is, that they had a U.S. partner that they wanted to involve. So they gave them a piece of the Australian corporate entity that owns the U.S. entity, which is, from a U.S. tax perspective, extremely inefficient. Because it's a U.S. guy who owns a foreign corporation that owns the U.S. corporation. There's a lot of layers there in terms of taxation. So if they would have come to us first, we would have perhaps definitely structured differently, and make it favorable from both the foreign investor and the U.S. investor standpoint. The fourth question that we consider is the type of business that you want to enter into. Fifth, what are your funding sources? Is it equity or is it debt? And each have different tax implications. A popular investing technique is using portfolio debt, where the interest payments are deductible in the US, but there's no withholding tax on the payments to the foreign lender. And then finally, how do you manage your relationship with your non-US business? Transfer pricing is quite complex. If the new US business is using the foreign owners, the foreign related foreign partners, trademarks or know-how, may be appropriate to enter into licensing agreements and have royalty payments go to that foreign owner. So those are the kinds of considerations that we discuss with our clients when they're entering our market. And then the next slide, I want to talk for a few minutes about transfer pricing and administration agreements. So it's essential to properly manage your relationship with your non-US business related party. And it involves understanding the rules of transfer pricing and the requirements. And the requirements exist not only in the US, but in every jurisdiction that I've dealt in. Both jurisdictions want the right profit to be earned in their right jurisdiction. Transfer pricing, just as a general definition, it refers to the prices charged for goods or services between related parties that are in different tax jurisdictions. And transfer pricing could also be a state tax thing, Rich. I'm not sure how much you deal with it, but every state wants their piece of the pie too, just like every country.
That's right. And in fact, that used to be a huge amount of audits were related between state A says you're underpricing that item or you're overpricing it, and therefore we're not getting enough tax. But the states made it really easy. They just, for the most part, have decided to disallow intercompany payments unless they're essentially selling the same product that they're selling to third parties. But anyway, that's a whole other thing.
It's a whole other thing, but anytime you cross a border anywhere, whether it's state border or a federal border, there's always transfer pricing concerns. Administration agreements, on the other hand, govern the allocation of costs and revenues between related parties in different tax jurisdictions. So these agreements are important to make sure that the home jurisdiction is being reimbursed for costs incurred to manage the back office on the behalf of the U.S. affiliate, or to perform any other services on behalf of the U.S. affiliate. So those agreements we often discuss with our clients, and we put them in place. Failure, there's risk of non-compliance in both jurisdictions. Failure can result in potential penalties. But the worst type of risk and the worst type of failure is facing double taxation. You definitely want to only pay tax on the income in one jurisdiction and not twice. So that's why it's important to consider, what prices you're charging through related parties, make sure it's defensible and that it's going to be appropriate for each jurisdiction. So I think that leads us to polling question number 4. So when investing in the U.S. market, which of the following is not a critical tax-related question to consider? A is the taxation of investors and applicable withholding taxes. B, the nature of the business activities and their tax treatment. C, the risks and benefits of investing in a haunted house. Or D, the type of business structure, such as corporation or business or partnership and its tax implications.
This may be the most difficult one we've had so far.
It is challenging, Rich. I think the Spumoni was easier.
More desirable.
We have about 70% of the votes in, so I'll just give it about 5 more seconds before closing the polls.
So the answer, 89% got it right. That's
I
fantastic.
think that's the highest so far, right?
What?
Highest percentage of right answers, I think, so far.
That's an A, I think, in my book. So the answer is C. It's important to factor in the other answers when considering an investment in the U.S. So there's my picture of the haunted house. So next I want to turn into an outbound investing for U.S. taxpayers who want to invest outside the U.S. And I'm going to talk about three areas in the outbound investing. The first is foreign tax credits. Secondly, the taxation of foreign investments, and the taxation of foreign passive income, because there's some unique circumstances there. And finally, the reporting requirements for foreign investments and foreign financial assets. So let's move on to the foreign tax credits and their availability. So when U.S. taxpayers invest outside the U.S., they may be subject to foreign income taxes on their foreign source income. And to avoid double taxation, the U.S. taxpayers can claim a foreign tax credit on their tax return. Foreign tax credits are available to both individuals and businesses. They can be used to offset the U.S. tax liability. However, there are limitations on the use of foreign tax credits. And understanding these limitations is critical to maximizing the benefit. And a lot of our time is spent in understanding these rules and determining how we can best maximize the foreign tax credits to offset our U.S. tax liability. One of the limitations is called the foreign tax credit limitations, a pretty unique name. And the limitation is based on the ratio of foreign source income to worldwide income. And it's designed to prevent taxpayers from using the foreign tax credits to offset the U.S. tax liability on U.S. income. So it's a formula: foreign source income over worldwide income times your U.S. tax liability is the limitation. And that's the maximum amount of credit you can take in that year. Another limitation on the use of foreign tax credits is the basket limitation. And this limitation requires taxpayers to segregate their foreign source income into various baskets based on type of income. One of the baskets is passive, which includes passive type income, dividends, interest. Another basket is general, which is what we consider mostly active income, income from businesses. A third basket is income from a controlled foreign corporation under the global intangible low taxed income or GILTI rules, and that's a separate basket. So I think there's 5 or 6 baskets in total, but the most common ones are those 3 that I mentioned. By understanding the availability and limitation of credits, we could really maximize the tax liability and maximize the return on these investments. So I want to switch to, we've moved to this slide, that when US taxpayers are investing outside, there's some investments that are taxed in a unique way. So I just want to spend a few minutes talking about those types of investments. And one type of investment that everyone may have heard of is called a passive foreign investment company, or a PFIC in their taxation. And it's often looked at as something to avoid. What a PFIC is, it's a foreign corporation with a majority of its income from passive activities, or the majority of its assets from that are considered passive, and cash is considered a passive asset. So often people, like startups, can fall into this category without even really realizing it. The tax treatment of PFICs is quite complex and can result in higher tax rates and interest charges. But sometimes the PFIC rules can be used to the client's advantage. For instance, investment expenses are currently not deductible in the US. However, if you have income from what we call a pedigreed PFIC, the income is included net of expenses. So if we're able to take a deduction from the PFIC income, there's certain unique situations that we could take advantage of the deduction, get a better return on those types of investments. Another type of foreign investment that people just need to be aware of are investments in controlled foreign corporations, or CFCs. A CFC is a foreign corporation in which US shareholders own more than 50% of either the vote or value of that entity. CFCs have their own special tax regime, including separate F rules and GILTI rules, which I mentioned earlier. And those rules come into play depending on the activities and income earned in the entity. But basically, the income from a CFC is taxed currently, even if the profits aren't distributed. Definitely a lot of planning we can benefit from in this area, but the rules are quite complex, but it is something to be aware of. And the third thing I want to mention is other types of foreign investments that can also have unique tax implications include foreign rental income, foreign dividends, and foreign capital gains. And the last thing I want to mention about outbound investments is the reporting requirements, which is on the next slide. US taxpayers with foreign investments and financial accounts are subject to a variety of different reporting requirements. These requirements are designed to promote transparency of investments and compliance with US tax laws, and failure to comply results in, really could result in very high penalties. So it's always good to be aware of these requirements. One of the key reporting requirements is the Foreign Bank and Financial Accounts Report, or the FBAR. The FBAR is required for US taxpayers with foreign financial accounts that are in aggregate greater than $10,000 balance at any point during the year. It's filed annually, and significant penalties exist for failure to file the FBAR annually. Another key reporting requirement is related to the Foreign Account Tax Compliance Act, or FACTA. And FACTA requires foreign financial institutions to report information on US account holders to the IRS. And US taxpayers with foreign financial accounts must also report this information on their US tax returns. So there's a matching opportunity for the IRS there. Failure to comply can result in also significant penalties, including a 30% withholding tax on certain payments made by a non-compliant taxpayer. In addition to FBAR and FACTA reporting requirements, there's many other forms. And there's, if you have a foreign trust, there's a form to report the foreign trust, the value of that. There's a statement of specified foreign financial assets. So there's a lot of forms and a lot of reporting requirements out there that if, non-compliance is, something that we can manage, but something you want to try to avoid. So that's my dissertation, outbound and inbound investments. I'm going to turn it over to Rich on corporate and sales tax. Oh, we have a polling question.
A polling question, yeah.
That's exciting. Which of the following statements is true about US taxpayers investing outside the US? A, they are not subject to US tax on their foreign source income. B, they are subject to U.S. tax on their worldwide income. C, they're only subject to U.S. tax on their foreign source income if they spend more than 183 days outside the U.S. Or D, they can claim a foreign tax credit to offset U.S. tax liability and foreign income, but only if they invest in a passive foreign investment company or PFIC. There's no ice cream or haunted houses here, so. Yes, the fun is over, Rich. Shivani, you'll let us know when.
Yeah, I mean, we only have 60% of the votes in, so I'm just going to
Okay,
give
all right, I'll be patient.
it.
And the answer, and 82% got it right, is B, that we're subject to tax on our worldwide income. Fantastic. Okay, so on to Rich.
All right, I just wanted to comment on, Lisa, you mentioned about the foreign, tax credits, which can be very helpful, right? It's interesting because most states, the vast majority, if you're a resident of one of those states, and you were to pay tax to a foreign country, for the most part, you cannot get a credit in a state for your income taxes, for taxes that you pay to a foreign country. There's some limitations. Canada seems to get better treatment than taxes paid to Canada. But so it's another area where, the states treat the taxpayer worse than the federal government.
Yeah, it's never a fun conversation when you say, well, you don't have US tax, on this income, but by the way, you have, 10% to New York State. So,
or to the earlier point, you have treaty protection,
yes.
but you might not have, or vice versa, So the next couple of slides, I just want to call everybody's attention to the word corporation. And the reality is that we could really simply say business income tax. So what we're discussing here could easily apply to businesses in addition to businesses that are formed as corporations. So most states impose a net income tax on corporations, and the income we were talking earlier about, like transfer pricing, how do we know that income leaving a state by way of a business deduction is being recognized in another state as income? Well, the state that is receiving the income has a desire to have that as high as possible in terms of the income, and the state that's where the item represents a deduction, an intercompany deduction, they want, of course, to lower that deduction. And that's where transfer pricing fits in the context of interstate taxation. And what transfer pricing does, just to repeat, as Lisa mentioned, is it tries to say, well, what is an arm's length price? What, if two related entities were not related, what would they be charging each other? But many, or if not most states at this point, have rules that unless you're selling a good or service to affiliate that is the same good or service that you would sell to your regular customers, you just can't take a deduction for an intercompany expense or serve, income. So anyway, how do the states then decide, assuming that's not an issue, how do states decide how much income, if you're a company and you do business in 20 states or 30 or 40, how does each state decide how much income they're entitled to tax? And we call that apportionment of income to states. And, there are certain ways over the years, tried and true, tested apportionment methodologies that have been blessed by, even the Supreme Court of the United States for doing that. And one way to do it is we call factor apportionment. And what you do is a business will look at the amount of property that they have in the state relative to the total amount of property that they have. And they'll look at the payroll that they have in the state relative to the total payroll they have. And then they'll look at the receipts that they have earned in the state relative to total receipts. So those are essentially three fractions. And then add them, divide them by 3, and you come up with your business allocation percentage to a particular state. Other states are now using, and by the way, sometimes some of the formulas will double weight receipts factors, triple weight receipts factors, give more weight to the receipts factor than to the property or the payroll factors. Now there are other states that have dropped the property and payroll factor. And there's an economic reason for doing that and just using a receipts factor, which is, it disincentivizes businesses from locating in a state that uses property and payroll as a measure of apportionment. In other words, if you have a lot of property or payroll in the state, you're going to skew the apportionment. It's going to be higher in the state where you have your property and payroll. But if you're just doing a receipts factor, then it's neutral. It doesn't matter where you decide to have your headquarters or offices or people working in those offices. It doesn't matter your state. What only matters is where the sales happen. So the property, payroll, receipts 3-factor discourages location of operations in a state, whereas the singles receipts factor doesn't. Now the question is, how do you decide what sales are in state? So you're going to have a receipts factor that's going to be in-state sales divided by all your sales. Some states use something called cost of performance. Where are you incurring costs associated with generating those receipts? And costs could be just generally anything, payroll, it could be rent, could be cost of goods sold. So that is one method, and that has been the traditional method. But as of late, as of let's say the last 5 to 10 years, states have moved by and large to market-based sourcing. And market-based sourcing looks to where the benefit of it, in this case, in this instance for services, looks to, so if you're selling services, goods is always going to be, where is the good sold to, where's it delivered, where's the customer? That's going to determine whether it's an in-state sale or not. But for services, we looked at cost of performance. But more modern approach for services is market-based sourcing, which basically looks at where does your customer or your client receive the benefit of your services. And frequently they receive the benefit of the service where they reside, right? But not always. So for example, if your service is providing online access to online software as a service, so basically you provide that access for a fee, give licenses to your customer. Now that customer may have a headquarters in state A, but they may have people accessing and using that software in multiple states. So in that case, the benefit of the service would not just be in the place where the company's headquartered, it would be where the software is actually getting used. So it's a more economic approach to just looking at where the work is done. It's not more economic, I mean, because you can measure cost of performance, but it's focused really on the economics to the customer, where are they receiving the benefit, versus to the service provider, where are they incurring the costs. Then other business taxes, so we're talking about net income taxes. There are other states that have business taxes that are not based on net income. Like Washington has the Washington Business and Occupation Tax. Ohio has a commercial activity tax. Those are based on gross receipts. They may be sourced under similar rules for net income taxes, but there's an important distinction we'll discuss in a moment. If we can move to the next slide. All right, so Nexus, we were talking about how does a state decide where the receipts were earned and who gets to tax them. But there's another issue, and which is how does a state have the right to demand that a tax return be filed in the state? And that's what we call Nexus. Traditionally, Nexus is based on physical presence for net income taxes, and also even for sales taxes. Traditionally, there's been changes. We'll talk about that. So, what is Nexus based on physical presence? It's, do you have property in the state? Do you have personnel in the state? Those are the primary, and the property could be real or personal property. If you do, then you have a nexus with the state that allows them to say, you need to file a tax return with us. And then you go into the allocation issues, which we just discussed, to decide how much income that state is going to get on that tax return. Public Law 86-272 protects businesses from nexus. So under certain circumstances, businesses are not required to file an income tax return with a state. Now, the key word here is net income tax. Remember on the last slide, I just indicated that there are a few states that don't have net income taxes. They have gross income taxes. And the Public Law 86, which is a federal law, 272, only helps in this instance where a taxpayer is subject to a net income tax. And it applies in the following situation, where an out-of-state seller of tangible personal property has no presence in the state, and the only thing they're doing is selling goods in the state. Those goods are sold through salespeople who solicit orders, but the orders are not approved by the salesperson. They're approved outside the state, back at, let's say, the headquarters, but they're not approved. Sales aren't approved within the state. So they just take the order. And the goods are shipped from out of state into the state. So two things have to happen. One, the order has to be approved out of the state, and the good has to be shipped from outside the state. And if the only thing that's happening in the state is the solicitation of the sale, then there's something called Public Law 86-272, protection from nexus. And you wouldn't even, the business wouldn't have to file a tax return. But for the Congress enacting this law, they would have to file a tax return. The reason that states like Washington and Ohio have gross receipts tax return is to avoid coming under this rule. So that in Washington, it's possible that Public Law 86-272 would not apply. The state could opt to have it apply, but it's not required to offer that protection. Economic nexus. We talked about first nexus based on physical nexus, physical contact, property, personnel. The law has been moving steadily to economic nexus, where merely having sales in excess of a certain amount within the state, determined using those allocation factors we discussed just before. If you exceed a certain amount of sales, then there's a presumption that you have nexus in the state. That nexus could be based on gross receipts. And let's go to the next slide. So in 2018, South Dakota versus Wayfair was decided at the United States Supreme Court. It involved a sales tax case in South Dakota where the company Wayfair, the company we all know, they sell furniture from out of state. They were trucking furniture in. They had no other presence inside South Dakota. South Dakota had a statute that said roughly something like this. If a business located out of state sells $100,000 of goods or has more than 200 transactions with customers inside the state, then for sales tax purposes, there is nexus. And even though there is no physical nexus in the state, it's just sales, the state said you have to file, you have to register for sales tax, you have to collect sales tax. And if you don't, then you get audited and we're going to charge, you're going to reach into your own pocket and collect the sales tax and pay the sales tax. Wayfair hadn't been collecting sales tax from their customers in South Dakota because they said, well, we don't do anything in South Dakota other than ship, basically ship stuff into there. We don't have payroll there. We don't have our own property there. We don't have offices there. Whatever's being shipped in there is being shipped in from out of state. And the Supreme Court validated South Dakota's rule and said, in this day and age where, physical presence is not as big a part of business as it used to be. It's most, huge portion of business is being done online, even if it's involves like Amazon, tangible personal property, people buy, and it's not realistic to tell the state that they can only tax subject a business to sales tax collection if they're actually physically located there. So that in 2018 changed everything. And since then, every state that imposes a sales tax, I'm pretty sure I'm right in this, maybe there's one that's missing, but I think every single state now that imposes a sales tax has adopted a statute based on economic nexus, either a certain amount of transactions or a certain amount of gross receipts occurring in the state. And they said, and once that happens, you're in the state, you've got to file, you've got to register for sales tax, collect sales tax, and remit sales tax to the state. Next slide, please. So we talked about there are 5 states that do not impose sales tax. This is more just, interesting than anything else. New Hampshire, Oregon, Montana, Alaska, Delaware, and the acronym we use in state and local tax to remember that is NOMAD. So, you'll see folks, they may try and say they're buying art, expensive art or something. They'll try and ship it in Delaware and then throw it in their car and drive it to New York. That's not good tax planning. That's not even tax planning. That's not appropriate or legal. But if you happen to be living in Delaware, it's great not to have to pay sales tax. Let's see, what else is on the slide? Do we have another slide? No?
It's time for our last poll question.
Oh, it looks like, and we're rolling in right on time, it looks like.
Yeah, I know, it's crazy.
So which of the following is which of the following is true about economic nexus? Economic nexus occurs when a business maintains an office in state. Economic nexus occurs when a business maintains an employee in state. Economic nexus occurs when business receipts exceed certain statutory thresholds in state, or D, none of the above.
This is the last polling question. So if you're looking for CPE credits, let's get that votes in. Okay, with that, I'm just going to close the polling. Share the responses.
And it looks like what percent? Well, the answer is C, and it looks like I can't see the percent there. I got the answer
53%.
83, so that's good. Yeah,
50.
I mean, the key there is, what's that?
53.
53. Oh, not so good. It's okay. The answer is, the key is that economic nexus does not require physical presence. So it doesn't, and that's the way that state taxation has been steadily moving and will continue to move. So even if you don't have an employee or office or inventory in the state, if you exceed a certain number of sales in the state or gross receipts, it constitutes nexus without physical nexus. It's just economic nexus. So that's why C is the correct answer. What do we do with the rest of the time we have? We have 8 minutes left.
I don't know, Rich. No, any good stories?
Does anybody, do we have the ability, does anyone have questions? Can we take any questions?
Yeah, Lisa, there was one about exit tax. Would you be able to say something about that?
Sure. So exit taxes. So if you're a green card holder or a US citizen and you want to either give up your green card or give up your US citizenship, there's the potential for a tax on the exit. And the basic premise is that it's as if you sold all your assets on the day before you actually expatriated. So it could be a pretty big tax. It really takes careful planning. There are ways to minimize the tax or avoid the tax through, gifting or through other means. But not everyone meets the thresholds, whether they're subject to exit tax. I think, Rich, there's a state tax.
Well, it's interesting. In terms of leaving a state, issues to consider, tax issues. One of the big ones that I've seen frequently, it has to do with many states. As an individual taxpayer, you're a cash basis taxpayer. You pay tax based on your net income incurred or received during the calendar year. But when you leave a state, and you frequently, not every state does this, but you frequently are put, your class changes to accrual basis, meaning that you used to be a cash basis, but on the last day of residency in the state, you're now an accrual basis taxpayer. And what that does is it means that any bonuses or payments of any sort that you're going to be receiving, and you pretty much know how much you're going to be receiving, and you're going to be receiving it after the date on which you break residency, you're now an accrual basis taxpayer. So even though you're going to receive it after you break residency, you have to report that item of income on your last resident or part resident tax return and pay tax on it. And then another interesting thing I've seen over the years is that most states, as I mentioned, will not tax non-residents on income from intangibles. And there are exceptions to this. New York has put a bunch of exceptions in, but sometimes if you are leaving employment and you sign a severance agreement or a non-compete agreement, the income from those severance or non-compete agreements are considered income from a contract or an intangible. right? You agree to surrender your right to sue your employer for any past grievances. In exchange, you'll receive this sum. You agree that you won't compete. In exchange, you'll receive this sum. So often when that happens, we would advise clients to make sure that those sums are due after you break residence. And in states that don't have an accrual rule, you get a pretty good result, especially if you're moving to a low tax or a non-tax state like Florida. In states that do have an accrual rule, that wouldn't be too helpful.
Thank you, Richard. We do have one more question. And it is, can you discuss state-sourced income versus residency?
Okay, so that's a great question because it goes to the heart of the issue. If you're a resident and you're paying income taxes, you're paying income taxes on all your income. It doesn't matter where the income is sourced. That being said, there is a mitigating credit. Residents in most states have credit that they can use on their resident tax return to pay their state taxes to the extent that the income was double taxed. Let's say it was taxed in the state, in a non-resident state, where the income was sourced to. And I'll give you an example of that. Let's say you are a resident of California and you have a rental property in New York and you're receiving rental income. You're a non-resident in New York. New York is going to say, well, that's New York source income because the real estate is located in New York. Even though you're not a resident of New York, you need to file a non-resident income tax return on that New York source income and pay tax. California says you're taxable on all your income, including that rental income. However, there is a credit available that you can that will help you and basically mitigate that, but a credit for taxes paid in New York State on the income that's subject to tax in California. And that is interesting because it also, had that property been outside the United States and not in Canada, you wouldn't get a credit. And so you'd be taxable in the foreign country that subjects you to tax. And you'd also be taxable in California. So that's kind of difficult spot to be in.
I'd say so.
So thank you, Richard and Lisa. I think it was a great presentation. I hope our audience got a brief overview of state and local taxes and international tax. And for your more specific questions, feel free to reach out to Lisa and Richard. Their information is shared on the next slide. So thank you, everybody. With that, we come to the end of the presentation for this quarter.
Thank you.
Thank you.